Hello, welcome to From Invoice to Payday, what every project team should know about liens and holdbacks. I'm Cindy Jimenez from Iconic Power Systems. This session is for all current and future members of Iconic who touch projects in Alberta and Ontario, and it's equally useful background for our work in British Columbia. Why are we here? Because construction payment laws can feel complicated, and yet they affect our day-to-day reality, how we invoice, how cash flows, when holdbacks are released, and what to do if payment stalls. My goal is to translate the legal framework into clear, practical steps so you can spot the key timelines, protect Iconic and our partners, and keep projects moving. Here's how we will proceed. First, we'll set the stage with why these laws exist and the core pillars, liens, the 10% holdback, and prompt payment timelines. Then we will walk through how Alberta and Ontario handle proper invoices, pay when and notice of non-payment deadlines, lien periods, and holdback release. We will also flag special situations like federal lands and off-site work tied to a project. Throughout, I'll keep this practical with examples you can apply on your next job. By the end, you will know the must hit dates, what documentation matters, and what the traps usually are, so you can prevent issues instead of chasing them later. All right, let's get started. Let's begin with why construction payment laws exist in the first place. Construction projects involve long chains of companies, owners, general contractors, subcontractors, suppliers, consultants, and labor. Everyone performs their work weeks or months before they get paid. And very often, payment depends on someone else being paid first. If money gets stuck at the top of the chain, everyone downstream feels it. That's how companies go into cash flow crisis even when they have done the work properly. These laws were created to protect the people who actually build the project, to make sure they are paid fairly and on time, even if there's uncertainty, delay, or dispute at higher levels of the contract. So, what do these laws do? They create a legal structure that forces three things. First, transparency. Everyone knows when they should issue invoices and when they should be paid. Second, security. If payment does not arrive, there is a legal remedy, such as filing a lien. And number three, flow of funds. Timelines legally prevent owners or contractors from holding money for too long without explanation. In short, construction payment laws were built to keep projects moving, to keep workers paid, and to reduce financial risk for everyone involved. Now let's talk about the problem at the heart of every construction project. Work is done first. Payment comes later. In most industries, you pay when you receive a product or service, but in construction, the model is reversed. A contractor may clear land, pour concrete, install cables, or finish an entire phase of work weeks or even months before seeing a dollar. During that time, they are already paying labor payroll, equipment rentals, material suppliers, insurance and bonding, subcontractors, and often interest on financing. So the longer the payment takes, the more financial pressure builds. And here's where the real issue comes in. Payment is often dependent on the owner releasing funds to the general contractor, who must then pay subcontractors, who must then pay subs, and so on. If one link in the chain fails, the entire payment flow collapses. That's why construction is one of the industries with the highest number of insolvencies in Canada. Not because companies do not know how to build, but because they do not get paid fast enough to survive. So the laws we'll talk about today, liens, holdbacks, and prompt payment, were created to fix this exact problem. Now that we understand why these laws exist, let's look at the three pillars that every project team needs to know: liens, holdbacks, and prompt payment. These three work together like a safety system in a construction project. If one fails, the others help keep money flowing and protect the people doing the work. Liens. These are legal claims that protect anyone who supplies labor or materials to a project. If payment is not received, a lien allows them to register a claim against the property itself. That means the owner cannot sell or refinance until the debt is dealt with. So liens create very strong financial pressure to resolve unpaid invoices. Holdback. This is the mandatory 10% that must be withheld on every project. The purpose isn't to punish anyone, it's a built in protection period that gives unpaid parties time to file a lien before all the money is released. Think of the holdback as a safety fund that stays untouched until the lien period expires. And finally, prompt payment. This one keeps cash moving. Instead of letting payments float indefinitely, the law sets fixed deadlines. When invoices must be issued, when owners must pay, and how quickly the money must flow down to subcontractors and suppliers. This is the part that was added more recently in provinces like Alberta and Ontario. So together, liens protect the right to be paid, holdbacks give time to act if payment is missing, prompt payment keeps the money flowing so we don't end up chasing it months later. All right, now that we have introduced the three pillars, let's zoom in on the first one, liens. Before we go into deadlines and provincial differences, I want you to think about this question. If Iconic finishes the work, installs the equipment, and submits the invoice, but the client doesn't pay, what real power do we have to collect? A lien is that power. A lien is not just a complaint or a reminder email. It's a legal claim against the property itself, the land or the project we improved. That's what makes liens so powerful. Once a lien is filed, the owner cannot sell, refinance, or legally move forward without dealing with the unpaid amount. It becomes a financial wall that cannot step around. So a lien basically says, we improved this property. Until we are paid, this property is not fully yours to do whatever you want with. And here's something important for everyone at Iconic to remember. Liens protect everyone in the chain, not just the general contractor. Suppliers, subcontractors, engineers, even equipment rental companies have lien rights. Number two, you don't need the owner's permission to file one. It's a legal right, not a negotiation. And finally, liens are extremely time sensitive. If the deadline passes, even by one day, the right is gone. No extensions, no excuses. That's why tracking lien periods matters. And here's the mindset shift I really want you to leave with. A lien isn't an act of aggression. It's a payment protection tool built into the law so companies do not go bankrupt, waiting on money they have already earned. So, as PMs, coordinators, and procurement staff, the key question is, do we know when the lien clock starts for each project and who is watching that timeline? Because the worst time to learn about liens is when it's already too late to file one. All right, let's move to the second pillar, the holdback, the part everyone loves and hates at the same time. So, what is it really? Think of the holdback as a built in safety fund that the law forces us to keep in every project. It's not optional, it's not a negotiation, it's 10% of the contract price that must be withheld in Alberta, BC, and Ontario. Why 10%? Because it gives anyone who wasn't paid, subcontractors, suppliers, labor, time to file a lien before all the money is gone. Here's a key idea. The holdback protects the people doing the work, not the owner, not the bank, not the general contractor. That's why it stays in touch until the lien period expires. And the timelines look like this. For Alberta, 60 days, or 90 days for oil and gas sites. For BC is 55 days after completion. And for Ontario, it's 60 days after lien period expires. So roughly 60 to 70 days total. In practice, here's how it works. We invoice for 100% of the work, but the owner only pays 90% and must retain 10% as a statutory holdback, unless the contract requires us to bill only the net amount. The remaining 10% sits in trust untouched for 55 or 60 days. If nobody files a lien during that period, the holdback can be released. But there's a trap many people fall into. The holdback is not automatically released. Someone must request it, track it, and make sure the release date is hit. And owners love when we forget because that's free cash flow for them. So the real questions for every iconic project are: who's tracking the holdback release date? Has the owner confirmed that we'll release it on time? And if there is no lien, are we pushing to get that last 10%? Because a holdback isn't profit. It's money we already earned. So if we do not chase it, that's not delayed revenue. That's lost revenue. Now let's talk about the third pillar, prompt payment. This is the part of the law that was created to finally fix the slow payment problem in construction. No more, we'll pay when we get paid. No more 90-day waits. No more endless excuses. The law now sets very clear payment deadlines, and everyone in the chain has to follow them. Here's how it works in simple language. First, iconic issues what the law calls a proper invoice. That must happen at least once every 31 days. That's the starting trigger. Once the owner receives that proper invoice, the clock starts. The owner has 28 days to pay us, not 45, not 60, 28 days period. Now, if the owner is not going to pay, they cannot stay silent. They must send us a formal notice of non-payment within 14 days of receiving the invoice. Not an email, not a we are checking with accounting, an actual legal notice. If they do not send that notice in 14 days, the law assumes payment is owed. Then it moves to us. Once Iconic gets paid, we have 7 days to pay our subcontractors. And those subcontractors have another 7 days to pay their subs or suppliers. So the payment chain now has a rhythm. Proper invoice, then 28 days for owner to pay, then 7 days for Iconic to pay subs, then 7 more days down the chain. And here's the most important part for project teams. If the owner doesn't pay us, we still have to send our subcontractors a notice of non-payment within 7 days, or we become responsible for paying them anyway, even if we never receive the money. That's why prompt payment isn't just an accounting rule, it's a risk rule. If we miss a deadline for issuing the invoice or sending the notice, we can end up legally forced to pay people out of Iconic's own pocket. So, whenever you hear prompt payment, I want you to think about these 3 questions. 1, did we issue the proper invoice on time? 2, are we tracking the 28-day payment clock from the owner? 3, if money isn't flowing, have we sent the required notice before the deadline hits? Because in Alberta and Ontario today, cash flow is no longer optional, it's regulated. Prompt payment is not just about getting money faster, it's about protecting the company. Now that we understand the 3 pillars, liens, holdbacks, and prompt payment, it's time to look at how these rules actually change depending on where the project is located. And this is where most people get caught off guard. Because even though we build the same kind of work, use the same contracts, and deal with the same risk, the law is totally different depending on whether the project is in Alberta, British Columbia, or Ontario. Same 10% holdback? Yes. Same lien rights exist? Yes. Same deadlines, same payment rules, same processes? Absolutely not. We are not going into the details just yet. That's coming next, but I want you to notice something. What's legal in Alberta might be non-compliant in Ontario. And what's normal in Ontario might not even exist yet in BC. That's why at Iconic, we never assume the rules. Before a project starts, we confirm which province's act applies, because the timelines, the lien rights, and even the payment clock all change based on location. So here's how we're going to break it down. Next slide, Alberta, the newest law, strict timelines, and one special exception. After that, British Columbia, no prompt payment yet. And then Ontario, the most complete system in Canada. Once you understand the differences, you will see why tracking the province is just as important as tracking the schedule. All right, let's start with Alberta, the province where most of Iconic's projects are based. Alberta used to operate under the old Builders Lien Act, but in 2022 it was completely modernized and renamed the Prompt Payment and Construction Lien Act, or PPCLA. So, what changed? The biggest shift was this: Alberta doesn't just have lien and holdback rules anymore. It now has mandatory prompt payment timelines and a fast track dispute system called adjudication. So here's what every project team member needs to remember about Alberta. One, a proper invoice must be issued at least once every 31 days. That's not optional. If we don't issue it, the payment clock never starts. Two, the owner has 28 days to pay us or 14 days to issue a formal notice of non-payment. No response? Payment is legally due. Three, once Iconic is paid, we have 7 days to pay subs, and they get 7 more days to pay theirs. So Alberta follows a 28-14-7-7 rhythm. And finally, four, the 10% holdback must be retained for 60 days, unless the project is tied to an oil and gas well site, in which case a holdback becomes 90 days. That oil and gas exception is unique to Alberta. You won't see it in BC or Ontario. And the last thing to remember, if payment is disputed, Alberta has a built-in adjudication process, meaning you can resolve a payment fight while the work continues, instead of stopping the job or waiting for a lawsuit. Now let's move to British Columbia, and BC is very different from Alberta. BC still operates under the older Builders Lien Act. That means the province has liens and holdbacks, but no prompt payment law yet. So, unlike Alberta and Ontario, there is no 28-day payment rule, no 31-day proper invoice requirement, no automatic 7-day flow down to subs, no adjudication system for fast dispute resolution. In VC, payment timing is still controlled by the contract, not by the legislation. So if the contract says net 60 or pay when paid, that's legal in BC. Until the new law passes, BC is still operating on the old model. But there are two important things BC still requires. This 10% statutory holdback still applies. And that holdback must be kept for 55 days after completion or certificate of completion. That 55-day period is shorter than Alberta's 60, but there's no prompt payment law pushing the money out faster. Now, here's a part to pay attention to. BC has already introduced Bill 20, which will bring prompt payment and adjudication into the law, very similar to Alberta and Ontario. So for now, BC is the traditional province, but hopefully not for long. Now let's look at Ontario, not just as a province with the most developed construction payment system, but as a first one to openly admit that something in the industry wasn't working. Ontario recognized that holding the 10% holdback until the very end of the project makes sense on a short job, but not on a 2 or 3 year project worth tens or hundreds of millions of dollars. In those cases, that 10% isn't just a small security amount, it's millions of dollars frozen for years. And that creates serious cash flow problems for contractors and subcontractors all the way down the chain. So, Ontario built a solution into the law, an optional annual release of holdback. Now that we have walked through each province individually, this slide pulls everything together in one place. Here you can see the side-by-side comparison of Alberta, British Columbia, and Ontario. Same industry, same type of project, but three completely different legal systems when it comes to liens, holdbacks, and payment timelines. And this is why it matters. The law doesn't follow Iconic, it follows the land. It doesn't matter where we invoice from, where the PM sits, or where the purchase order was issued. The moment we put a shovel, a bolt, or a transformer on the ground, that province's rules apply. So when you look at this comparison chart, the key takeaway isn't to memorize every number. It's to understand that every project starts with the same three questions. Number one, which provincial act governs this project? That tells us the lien period, the holdback rules, and whether prompt payment is mandatory or just contractual. Number two, who is tracking those deadlines? Because lien rights expire automatically. Holdback money does not release on its own, and prompt payment notices have strict cutoff dates. And number three, what changes for us because of where this project is located? Because what is perfectly legal in BC would put us in breach in Ontario, and what works in Alberta might not exist yet in BC. If we clarify those three things at the beginning, the rest of the project flows properly. If we don't, that's when payments get delayed, lien rights get lost, and we spend energy fixing something that could have been prevented just by knowing the rules on day one. So, before mobilization, before procurement, before the first invoice, we need to mobilize the legal timelines too. The provincial chart is not just for information, it's a reminder that the rules change the moment the map changes. Before we move on, let's pause for one more important point. There's a second piece of legislation, Bill 60. Bill 60 doesn't undo Bill 216. It refines how it will be applied. Under Bill 216, the idea was that annual holdback release and lien expiry would be linked together, which would have forced contractors to file liens every year just to protect their rights. Bill 60 fixes that by separating the two. Annual holdback release will still be mandatory, but it will not trigger lien expiry anymore. So, companies will still get yearly release of holdback, but without the risk of losing lien rights. So, it's very possible that in a few years, annual holdback release won't just be an Ontario rule. It could become the national standard for long duration projects, which means the companies who prepare early will adapt easily, and the ones who wait will be forced to adjust under pressure. For us at Iconic, the goal is simple: stay ahead of the curve, not behind it. Now that we have said the law depends on where the project is physically located, let's make that real and look at a few examples you might actually see at Iconic. Example 1, we are building a substation in Edmonton. Even if the PM is based in Calgary and the engineering team is in Ontario, the work is happening in Alberta. So Alberta's Prompt Payment and Construction Lien Act applies. That means 28-day owner payment, 60-day lien period, and a 90-day holdback rule only if it's tied to an oil or gas well site. Example 2. We install underground cable in Vancouver for a municipal project. The work is in BC, so the Builders Lien Act applies. There's a 10% holdback for 55 days, but no prompt payment law yet. So payment timing depends entirely on what the contract says, not the statute. Example 3. We do a 2-year rebuilding project in Toronto. Now we are under Ontario's Construction Act. That means prompt payment adjudication, a 60-day lien deadline, and the option soon to be mandatory for annual holdback release. Same company, same type of work, same contractor name on the invoice, totally different rules simply because the work is happening in a different province. And this is why just copy what we did on the last job doesn't work anymore. The legal framework resets the moment we cross a provincial border, and so must our timelines, our contract review, and our internal tracking. So whenever someone on a project says, "What's the lien deadline?" or "When does a holdback release?" the correct response is always, "First tell me where the project is, then I can give you the answer." Now that we have talked about how the laws work and where they apply, the next question is, what kind of work is actually protected under these laws? Because not every task, service, or purchase falls under lien rights or prompt payment rules. The general rule is simple. If the work, service, or materials are directly tied to the improvement of land, they are protected. So that includes things like construction, installation, and field work on site, design and engineering that is specifically for that project, supply of materials that will be incorporated into the project, equipment rentals used to perform the construction work, fabrication done off-site if it is made for that specific job. If it contributes to the physical improvement, even indirectly, it is usually covered. But there are also things that look related to the project but do not qualify. For example, general office work, admin, or project coordination, consulting that doesn't create a physical change, cleaning or maintenance after the project is finished, company-wide supply purchases not tied to a specific site, equipment but for general use, not a particular job. So if we buy laptops for the PM team, that's not lienable. If we fabricate switch gear for a specific substation, it is. If an engineer designs a one-off layout for a project in Ontario, they are protected by Ontario's Act even if they never step on site. The question to ask is always, is this work or material being provided for this specific project and will it form part of the improvement? If the answer is yes, lien, holdback, and payment laws apply. If the answer is no, it falls under normal commercial rules, not construction law. Now let's talk about one of the most common exceptions people forget about, federal land. Everything we have covered so far, liens, holdbacks, prompt payment, applies only on provincial land under the provincial statute. The moment a project is located on federal property, the provincial lien laws no longer apply in the usual way. So what counts as federal land? Airports, military bases, RCMP facilities, some hospitals, federal office buildings, certain port authorities, anything owned by the government of Canada. Here's the key point. If we are working on federal land, don't assume the same lien rights exist because the provincial legislation that creates lien rights doesn't apply to federal real property in the way it does to provincial land. Instead, what protects us is the terms of the contract, including payment security or bonds, and the Federal Prompt Payment Regime, the Federal Prompt Payment for Construction Work Act, if it applies. So the checklist becomes: confirm whether the project is on federal land. If yes, don't assume lien rights automatically. Check whether the contract includes payment security, such as a payment bond, or the federal prompt payment law applies. If there is no bond and no federal regime kicking in, the payment risk must be priced, negotiated upfront. Because once we are on federal land, the law that applies is different. It's not the provincial lien law. That means identifying jurisdiction early isn't just a legal technicality. It's a critical financial protection. If we only discover it's federal once there's a payment problem, it may be too late. Another special situation that often causes confusion is off-site work. Things like engineering, design, prefabrication, or manufacturing that happens somewhere other than the construction site. The key principle is this: if the work or material is being done specifically for that project, it is still protected under the same lien, holdback, and payment rules, even if it never touches the site until later. So, for example, if our engineering team in Calgary designs plans for a substation being built in Ontario, those services are protected under Ontario's Construction Act, even though the engineers never leave Alberta. If equipment is fabricated in a shop and later delivered to the site, the fabrication works is lienable because it was created for that specific project. If we rent equipment or buy materials for a particular project, those suppliers have lien rights tied to the site where the work is being done, not where they are located. But here's the other side of it. If the work is not tied to a specific project, it is not covered. So things like general consulting, training, admin support, internal planning, or stock inventory do not fall under lien law. So the question to ask is simple. Is this work, service, or material created for this exact project? And will it form part of the improvement? If yes, it's protected. If no, it's just a normal commercial transaction. That distinction matters, especially when we are subcontracting engineering, prefabrication, or specialty vendors. They might have lien rights even if they are never seen on site, and those deadlines and notices still have to be tracked. Another special situation we need to understand is the difference between public projects and private projects, because even though the work may look the same, the legal rules and payment protections are not always identical. On a private project, like a commercial building, a subdivision, an industrial plant, or a privately owned substation, lien rights, holdback rules, and prompt payment timelines follow the provincial legislation exactly as we have discussed so far. The owner is a private entity and the laws apply without exception. But on a public project, meaning the owner is a government body such as a province, a municipality, a school board, a health authority, or a crown corporation, the project is still covered by the Lien Act, but the remedies are different. Here's a key difference. You can still file a lien on a public project, but you cannot lien the land itself because public land cannot be seized or sold. So instead of a lien registering against the property title, it registers against the holdback funds that the public owner is required to retain. That means on public projects, our lien rights attach to the money, not to the land. And this is why tracking holdback release on public jobs is critical, because once a holdback is released, the lien fund disappears, and with it, the legal leverage we would have had. So the takeaway is this. Public projects do have lien rights, but they are enforced differently and they expire as soon as a holdback is released. Which brings us to the next slide. The two questions that tell us instantly whether lien law applies at all. Before we assume lien rights exist or that holdback rules apply, we need to ask two questions that completely change the legal outcome of a project. The first question is who owns the land? Because if the land is owned by a private party, provincial lien law applies. But if the land is owned by the federal government, like an airport, a military base, or federal office, lien rights do not exist no matter how much work we do. So the very first step in any project is confirming the jurisdiction of the land, not just the location of the work. The second question is the work physically tied to a specific project site? Because lien rights don't just depend on the type of work, they depend on whether that work becomes part of a physical improvement. So fieldwork, installation, engineering tied to a specific build, prefabrication for a job, those are lienable. But general consulting of site admin, training, or inventory purchases not tied to a specific project, those are not protected by lien law. So before we count on lien protection, before we rely on holdback timelines, before we assume prompt payment applies, we need to answer only two things. Who owns the land? And is this work tied to a physical improvement at that site? Before we talk about values and lessons learned, let's imagine a real world situation that could happen on any project. We purchase materials for a project and the supplier issues an invoice the day the goods ship, say November 5th. The project owner, however, pays on a progress draw cycle that typically lands 45 to 60 days after our billing, with a 10% holdback sitting longer. Now, based on Iconic's internal payment policy, supplier invoices are scheduled for payment on the last day of the following month. So, an invoice dated November 5th is slated for December 31st. We do this intentionally. It aligns outgoing cash with incoming progress receipts from owners, avoids financing projects out of pocket, gives us time to reconcile delivery versus install versus billing, and lets accounts payable batch and clear exceptions at month end instead of rushing mid cycle. In this scenario, the timing gap becomes real. The supplier expects funds on their commercial timeline, while our cash inflow depends on the owner's progress payment and statutory holdback rules. Some suppliers might be fine with that. Others might respond by tightening terms, asking for deposits, increasing prices to cover their carrying costs, or limiting credit until a payment history is established. That creates a practical tension. We're trying to line up cash so jobs stay liquid, while the supplier is trying to keep their own working capital healthy. The result is a simple but important question. How do we keep our end of next month policy, which protects project cash flow without pushing suppliers to price in extra cost or require earlier payment? One way to look at it is that neither side is wrong. We are protecting project cash flow. The supplier is protecting their working capital. So instead of asking who should change, the better question is what options exist so neither side carries the full burden. Maybe that means building longer term agreements with key suppliers so payment timing is understood up front, not negotiated invoice by invoice. Maybe it means offering early payment only when there is a real financial benefit, like a meaningful discount. Maybe it means matching certain suppliers to certain project types depending on the cash cycle. Or maybe it's as simple as clearer communication early in the PO process so expectations are set before the invoice is ever issued. These aren't rules, and they are not decisions. They are just possibilities. The point is that timing, pricing, and relationships are all connected, and sometimes a small adjustment on either side can prevent bigger tension later. And that brings us to the reflection on this slide. Understanding how lien, holdback, and prompt payment laws work helps ensure that every iconic project runs smoothly, fairly, and in full compliance. By following the right timelines, keeping proper holdbacks, and respecting each province's rules, we protect our teams, our partners, and the company's reputation. These laws exist to make sure everyone who contributes to building Canada's infrastructure can trust that their work will be respected and their payments protected. When we understand and apply these principles, we continue to build with integrity and accountability across Canada. If you have questions, comments, or ideas for future topics, you can send them to the email shown on the slide. We welcome questions, we welcome feedback, and of course, we never turn down kudos. Thank you for your time and for the work you do to help Iconic succeed. I am Cindy Jimenez, and I look forward to our next session.